Hi there, welcome to Kneppy Invest. Now, I am only human and I make mistakes. In fact, I make mistakes all the time. And it's how we deal with our mistakes that sets us apart from other investors, hopefully, anyway. So if we keep making the same mistakes over and over again, we're really not going to improve as investors. But if we take our mistakes, see where we went wrong, and then try not to make the same mistakes in the future, that's how we improve as investors. And this is really true to life as well. So I thought in this video, what I'll do is I'll just show you some of the mistakes I've made recently in regards to my technical decisions and how I'm learning from these mistakes. Now, this was a recent comment in my YouTube, or one of my YouTube videos, and this was from someone out there. I haven't put their name to this, just because I don't know if they want me to share their comment, but they just mentioned they watched several YouTube videos on how to trade in the stock market, but I haven't made any head start because they're either talking some gibberish or sharing the story of how they made it, and I do not want to make mistakes by taking risk in my own hands. And I don't think we should be afraid to make mistakes because, again, that's how we learn. And in a way, I think we should be embracing making mistakes because, again, that's how we learn to become better investors. So don't be fearful about making mistakes unless you keep on making the same mistakes over and over again. Before we get into some of my mistakes I've made in recent times, I'm just going to talk about a pretty important distinction here, and that is the difference between wrong decisions or choices and bad decisions or choices. And this is actually true in life, not only investing. And in fact, I'm going to use my professional career in weather forecasting. So I am actually a professional meteorologist. I actually do weather forecasts. And there is a big difference between a wrong weather forecast and a bad weather forecast. Now, in weather forecasting, we have a lot of information, but the information we have is incomplete because we can't simulate the atmosphere absolutely 100% perfect. But when we make a weather forecast, we take all the information we have and we spit out a weather forecast. But sometimes that weather forecast can be wrong because of that incomplete information. And that is a strategy, the correct strategy behind a weather forecast. So you can have a wrong forecast, but it's not a bad forecast because we've taken the information and have come out or spit out a weather forecast. So I've just written here, a wrong decision or choice is when we're true to our strategy, but in investing circles, the trade moves different way to our expectations based off our strategy. Now, our strategy might need working and we might need a different strategy, but if we follow our strategy and the trade moves different to that strategy, that's a wrong choice. Now let's talk about how that is different than a bad decision or choice. Now, in weather forecasting, a bad forecast, and this does happen a lot, is when you take all the information, and information can include your own experience and your own intuition. That actually is information. But a bad forecast is when you completely ignore all the information you have, including your own experience, your own intuition, and you spit out a forecast, and that forecast is against everything. And sometimes that forecast can come true, or more than likely it will be wrong, it will be incorrect. So a bad decision is when you go counter to your strategy, and it doesn't matter how the trade moves. You could be lucky and the trade could go your way, but more than likely the trade will go against you. So that is a bad decision. And I think we should be embracing wrong decisions, but we don't want to make bad decisions. We want to make wrong decisions and learn from those choices. Now, my first mistake is a company called Satisfatrio, which is interesting because I'm recording this video about 11 a.m. local time on the 3rd of February, and Satisfatrio have released their first half results, and really interesting trading in regards to these first half results in the first 2 hours of trading, because initially the share price opened up 6% and currently share price is down 20%. In fact, I might do a video on the trading and the results of Satisfatrio because there was really significant growth in their revenue, but there were some other really big red flags when you dig a little bit deeper into their results. In particular, when you look at advertising and marketing, it increased sevenfold in the past year. In fact, advertising and marketing were about 25 million and gross profit were 21 million. So significant increase in costs for Satire in the past year. And that is one of the reasons we did see a significant increase in their revenue. But I think initially the market liked the results, but as those investors who dug a little bit deeper, they saw some significant red flags. And that's the reason why we saw a massive swing in the share price for this company. But the whole point of this video is not talking about what's been happening with Satire today. It's about my mistake when it came to trading Satire in the past. Now, I did buy Satire back towards April, May of last year. Share price was hovering around about $1.40 to $1.50. Share price was in a nice little uptrend from when they listed on the ASX back towards the end of 2020. So we did see a nice rise in share price. So there's a lot of hype in this company at that point in time. And after I bought into Satire, share price kept on rising. But I sold out a little bit too early because of some negative rumors out there. We saw the share price fall significantly in one day because of these rumors. In fact, it fell from about $2.50, $2.60 to about $2. And I decided just because of those rumors, I would sell out on that day. But over the next few months, in fact, the next 6 months, we started to see share price rise again. In fact, the share price rose from that $2 when I sold out all the way to a high of $4.80. And you can see during that period, the uptrend in the share price remained intact. Now, recently, we have seen sentiment shift in this company, particularly when we take into account what's happening with share price today. It does look like it's sentiment shifting. And even though the uptrend is still intact, I think we might be seeing Satire share price move into a downtrend, possibly even today. So these are the things I've learned when it comes to Satire. Be patient. I was a little bit too quick hitting that sell button. I sold on the day. There was all these rumors. In fact, I forget what these rumors were all about. So be patient. You don't have to take or make a decision on the day where you hear these rumors or you see some financial results from the company. The other thing I've learned is don't sell in uptrend. So even though the share price did fall by a fair bit on this particular day, the uptrend was still intact. The other thing is ignore rumors. So I can't even remember what these rumors were about, and more than likely they were not true. So those are the three things I learned from my mistake with Satire. Now, it's really humid in Brisbane, so particularly over the last few days. So if you do see a little bit of sweat coming off my brows, and in fact, my right shoulder there is a little bit wet because of the sweat. So as a professional meteorologist, when we talk about humidity, we actually just talk about dew point, not relative humidity. You could have relative humidity of 100% in Antarctica, but it's not humid. So if you don't know anything about weather, if you look at any observation, look at the dew point. And right now, the dew point in Brisbane, or over the last few days, it's been hovering between about 21 and 24, and that is humid. No matter the temperature, that is going to lead to a humid day. And this time of year, any sort of dew points above 20 to 24 in this part of the world will lead to a humid day. If you go to Melbourne, if you see dew points above 15, that is a high humidity. If you go to Adelaide, the same sort of thing. But if you go to Darwin, they regularly see dew points above 20. In fact, above 25 would not be that rare in that part of the world. So weather lesson ending. Now on to my second mistake, and that is AI Media. This is a company I've been following. And then towards the middle of November, we did see a share price tank over 2 trading days. I can't remember exactly why it tanked, but it wasn't anything significant. And the share price fell from about $1 all the way to a low of about 70 cents. And because of that drop in share price, I decided to take a position. And this is something I have done in the past. And sometimes it works, but a lot of times it doesn't. And then over the next month or so, the share price just went sideways, which is not a good sign. So if the share price goes sideways after 2 big down days, there's not a lot of strength in people thinking this is good value. And after that month period, share price started to go down again, and we saw the share price fall all the way to 55 cents about a month later during that overall weakness in the market. I actually did sell without much of a profit, maybe a 5-cent profit, but the reason I sold was the share price just went sideways during that period. But the thing I really learned about AI media on this occasion was don't buy on negativity. And I've seen this time and time again. When we do see the share price fall a lot in one day, and people think this is a great time to buy these company shares at better value. But it's all about recency bias. And even though I'm not going to show you in this video, PushPay is a prime example. We saw some negativity when they released some results about 2-3 months ago, and the share price fell from something like $2 to $1.60 or 70 cents. And I remember, I'm not going to name any names, I remember someone saying, this is a great time to buy some PushPay shares because it's much better value now and the market's completely overreacting. So you can just imagine, because I'm talking about it, what the share price is right now with PushPay. It's actually just above $1. So the market really hated those negative results from PushPay, and the share price has kept on tumbling. So the thing I've learned with AI media and other companies like PushPay is you don't buy on negativity. Now onto Aussie Broadband, and this is a company I bought around about $2.70 back in April or March of 2021, about 6 months after they listed on the ASX towards the end of 2020. You can see the share price moving up from when they listed to when I bought. So the company's shares were in an uptrend at that point in time. So that was one of the signals why I bought into Aussie Broadband. The other signal is I do like the company itself. And from when I bought into Aussie Broadband, the share price just went sideways for about 4 to 5 months. So just a consolidation period at that point in time. But at the start of August, there was a breakout in the share price on higher volume. And in fact, the share price rose from $2.80 all the way to $3.80 in about a 2 to 3 week period. And I thought I'd be really smart. And I thought because we saw a really rapid increase in share price, the shares would pull back. So I decided to sell towards the top of that increase in share price period, and then I'll buy back in lower prices in the future. But we saw a 2-week period where the share price just went sideways, sort of like a flag or pennant period. And that's actually showing there was some strength in the company's shares at that point in time. And then the share price took off again towards the middle of August. In fact, the share price went from $3.80 to a high of $5.60, which was reached towards the end of November. And we have seen a little bit of weakness move into the Aussie Broadband share price recently. But my big mistake when it came to Aussie Broadband were these 3 things. I was not patient enough with Aussie Broadband. Now, I saw that rapid rise in share price, and I thought I'd be smart and take some profits and buy back in at lower share price. What I should have done is to see how the share price reacted from that rapid rise. And whenever you see share price just consolidate, like what you see with Aussie Broadband at the top, that is a sign of strength. The other thing is don't sell in uptrends. And there was a well-defined uptrend with Aussie Broadband at that point in time, and that was my second mistake. My third mistake is when I saw my thesis not playing out, or my strategy, the share price was not pulling back, the share price was just consolidating, I shouldn't have been afraid to buy back in, because we did see share price take off after that consolidation period had come to an end. So again, be patient, don't sell in uptrends, and don't be afraid to buy back in after you've sold when your strategy is not playing out. Now into a company that I've held for a long, long time, Electro Optic system. I do think this company is really undervalued right now, and I wouldn't be surprised to see the valuation of this company increase tenfold over the next 3 to 5 years. But just because I believe this company has a really bright future doesn't mean I have to be holding this company's shares, particularly when the shares are in a well-defined primary downtrend, which is what's been happening to the shares of this company over the past year. In fact, the shares of EOS moved into a downtrend towards the start of 2021, and they've been falling ever since then. At that point in time, the share price was about $5.50, even almost $6. And the current share price from when I did this video or set up this video was $1.86. But the company did release an Appendix 4C recently, and it was a very positive Appendix 4C, and the share price has recovered from there. This could be a short-term bounce because the shares are still in a well-defined downtrend. But the main thing I've learned from EOS and other companies that are in my portfolio is just because I like the future of the company, it doesn't mean I have to be holding the shares of that company. I can sell out when I see or get a sell signal, and I did get a sell signal way back towards the start of 2021. And if I sold out of EOS at around about $5 when I received those sell signals, I could be buying back in when I get a buy signal in the future at much lower share prices. So the main thing I've learned from EOS and other companies that have seen significant reduction in the share price over the past year is don't hold in primary downtrend. And I think this is going to be the hardest mistake that I've made to ignore or fix in the future, because I will find it really hard not to be holding a company that I think has a really good future, even if the share price is falling. Now on to another company, just like EOS, I think has a very bright future, and that is Clintonville. I've been wanting to, or had been wanting to buy shares in this company for the longest time, and I had my opportunity when I received a buy signal towards the end of August when they released their full year results right there. We had seen the share price of Clintonville moving sideways, consolidating for about a 4 to 5 month period. And their share price broke out of that consolidation period on large volume, so a definite buy signal at that point in time. And the share price kept on rising, so it increased from about $30 all the way to a high of $44.50. And after that high, which was reached towards the end of September, share price just drifted lower over about maybe a 1 and 1.5 month period. And then there was some rumors out there about the possibility of increased competition in the space that Clintonville is working in. And that's why you see those two big red down days towards the middle or start of November. Share price decreased from $39 all the way to $32 to $33. Now, that was not a sell signal, particularly at that point in time. The sell signal is what happened over the next few weeks. The share price just went sideways, was consolidating, which was sort of a flag or pennant, sort of the opposite to what we saw with Aussie Broadband after that run up in the share price. Share price then went sideways, and that was showing strength in Aussie Broadband. This is a complete opposite, and that was a sell signal at that point in time. I just did not listen because I like the future of this company. And then the share price kept on dropping after that flag or pennant was broken. Share price has drifted lower. In fact, it's fallen from $32 all the way to a low of $21. And there's still a lot of negative sentiment in this company, even though their Appendix 4C was pretty good. So my mistake with Clintonville is I did not sell a negativity and confirmation of that negativity towards the middle of November last year when the share price was 32 or 33 cents. And again, even if you do like the future of the company, you don't always have to be holding onto the shares of that company. And that is something I am learning slowly right now. That's all I have for this video about some of the mistakes I have made recently. And these are just technical mistakes, not fundamental mistakes. The biggest thing I have to learn in the future moving forward is even if I like a company, I don't have to be holding that company forever. I can trade in and out of those companies' shares, particularly if the company has moved into a well-defined downtrend. If you want to leave some comments about any of my mistakes you've made in the past and how you've learned from those mistakes, I'd love to hear your thoughts, your opinions, and if you do have any questions, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. I'm going to move into some air conditioning and cool down because I am feeling a bit hot, as you probably can see by some of the sweat and the wetness of my shirt. Have a great day. Talk to you later. Bye.